Hello again, everybody. Here we are again with that lecture with the extraordinary lengthy title, Foreign Relations Tax Act and Comparable Rules Against Tax Saving Models in International Cases. And now we are going to begin with the material contents. So the first question we have to talk about here in chapter 2.1 is transfer pricing issues. So everything which has to do with transfer pricing. Here is where we are now in the overall structure. Yeah. So the first thing we should do is just repeat basics, because my experience is usually basics are some time ago, and it's better to see the specific rules in the contents of the basics again. So what are the normal rules for transactions with related parties? The first thing is you have to distinguish between the different legal forms. It completely depends on if you have to do with a capital company, with a partnership, or perhaps even with two sole traderships belonging to the same owner. In case of a capital company, you know there is the rule that business with shareholders has to be done under market-conform conditions, as if it were business with an unrelated third party. So you need to act according to the so-called arm's length principle. And if you deviate from this, you either have a hidden profit distribution or a hidden capital contribution. If you have to do with a partnership, then contracts with partners are, in most situations in German tax law, not really accepted as existing contracts, especially for services. The relationship is usually changed in and requalified in you get an additional share in the common profit from the partnership. So you remember that was probably something which was called income from or the Sonderbilanz revenue or Sonderbilanz profit and loss statements. So, ladies and gentlemen, that is a completely different movie. Sometimes it happens for, let's say, sales of assets between a partnership and a partner, that can be accepted, but very often contracts are completely ignored. And when you have two different firms of the same owner, then in all probability, no, not in all probability, then even always, contracts are even impossible, because if a sole tradership exists and a second sole tradership and they both have the same owner, the sole tradership, that's just things belonging to that owner, and all the employees act in the name of that owner, and the owner cannot do a contract with the owner, him or herself. If you try to make a contract with yourself, that ends up probably in a home for the mentally ill, either indefinitely or for a short curative visit. So definitively impossible. And these are the situations on which we have to look first. In which movie are we sitting today? Because that's the important distinction which you have to make. Okay, now let us look on the first alternative, which is probably the most important one: transactions between or with companies. So let's have a look. First, repeating the basics is important. When you deal with your own company as a shareholder or so, then you have to know about hidden profit distribution and hidden capital contribution again. Hidden profit distribution was nothing else than a situation where a careful and responsible manager of the company would not have agreed to the contract in question if there had not been the need to take into account the wishes of that shareholder in the background. So that's a definition by the jurisdiction. And that simply means, in the final effect, that you have to deal with your own company under market-conform conditions, and the hidden profit distribution is a deviation from that. So if you do something which is more favorable to your shareholder, give him or her something for free. The hidden capital contribution is a similar thing, but just the opposite thing around, the other way around. A financial advantage given to the company which an ordinary contract partner would not have given without being motivated by the shareholder relationship. So without having in mind, I am the shareholder. So a hidden capital contribution is also marked by deviation from the normal market conform conditions. And now if you want to find out if such a thing exists in your case, in your transaction, there is a common recommendation how you can identify both of them. Split up the transaction in question in your imagination into two parts. First, the market conform part. So do imagine as if things had happened in the ordinary way in which they should have happened if there had been market conform conditions agreed upon, and then treat that transaction exactly, or that part of the transaction exactly as if that had happened. And then the deviation, the difference between the market price and what really was paid or done, is then either to be treated as a hidden profit distribution, because then that is that hidden profit distribution, or it is a hidden capital contribution. Now, naturally, one question follows, but that is a question how you keep these things apart. But first, let's look on some examples to illustrate these things. Let's say a shareholder buys a house for a price of 500,000 from his GmbH, although this house is in reality worth 800,000. So this is clearly deviating from market conditions. This is not market conform. Third, unrelated parties would have never agreed to that contract if they had been in clear mind and not mentally ill. So we have to split it into two parts in our imagination. First, we do as if the house had been sold for 800,000. So our GmbH would have to show 800,000 revenue from selling the house instead of only 500,000. And the difference between the 500,000 and the 800,000 would then be a hidden profit distribution. The hidden profit distribution must be treated in a way that it does not lower the income. You find that in section 8, paragraph 3, sentence 2 of the German AStG, so Corporation Tax Act. So that difference of 300,000, that we took less than 800,000, must not lower the measuring of the income. So we indeed have to calculate with 800,000, and that we renounce on the 300,000 means nothing else that after we made that revenue of 800,000, we one second later we give that 300,000 back to the shareholder in form of a dividend. But giving that 300,000 back to the shareholder is not an expense, but a kind of a dividend payment. And so dividends are not expense. So that is the reason why the hidden profit distribution is said not to lower the income, because it's a dividend payment, not an expense. Example number 2. A shareholder now sells a house for 500,000 to his GmbH, and that house has a market value of 900,000. So again, a house, but everything different. Now the shareholder sells the house to the GmbH for too low a price. Consequence, the transaction is evidently not market conform. Now we have to do as if the house had been sold for the market price in our imagination. So the first part of the transaction is house is sold for 900,000 from the shareholder to the GmbH. Logical consequences would be our shareholder receives a price of 900,000 instead of 500,000 only, and the GmbH will show the building in its tax balance sheet with the market conform costs of acquisition of 900,000. Then we think about the difference in the price, 400,000, between the market price and the agreed price of 500,000. This is a hidden capital contribution in this case. And a hidden capital contribution has to be treated as a contribution. So if a shareholder makes a contribution of 400,000, that means for the shareholder a contribution is not an expense but an investment. So the cost of acquisition for the shares go up in form of subsequent costs by these 400,000. No expense but an investment. So you have to recognize it as additional or subsequent cost to an asset, and this asset is the shares. And the GmbH, on the other hand, which receives 400,000 as a contribution, does not make a profit, because a contribution is something which comes from outside the enterprise, has been shifted in by one of the owners, and so a contribution was nothing which was earned within the enterprise, so no profit. The additional equity which comes from showing the house was 900,000 is not profit but is additional paid in capital of the GmbH. Okay, now let's come to the puzzling and confusing question, at least for beginners. How do you keep these two different things apart? They have in common something happens which is not market conform. Now, well, how can we keep things apart? The simple answer is make yourself clear, a hidden profit distribution is nothing else than a profit distribution which has been hidden. So a profit distribution, if you openly and honestly do it, is called a dividend. So a dividend is usually, no, not usually, a dividend is always paid from the company to the shareholder. So a hidden profit distribution also requires that the company gives something to the shareholder. And the only thing is they do it undercover, and so it's called a hidden profit distribution. Sorry. Now, a hidden capital contribution is nothing else than a contribution which has not kept the official formalities, so it has been hidden in the one or other form, undercover, in the form of a contract. Yeah. And a contribution is something which a shareholder gives to the company, not the other way around. So the easy way to distinguish the two things is just think about who gets money from whom, or where, in which direction does the financial advantage flow. If the company gives something for free to its shareholder, it's a hidden profit distribution. If the shareholder gives something for free to the company, this is a contribution, in that case a hidden capital contribution. Okay. Now, if you want to keep them apart, Joss asks, well, that is what you never may forget. Who gives a financial advantage to whom? Is it contribution or profit distribution? Then you never have problems here. Which forms can a hidden capital contribution take? Well, a hidden capital contribution is a capital contribution which has been hidden. So it can only be something which also can be an open capital contribution. And under German company law, you can only contribute to an enterprise money or assets. You cannot contribute a service. For example, you can never say, I'm going to found a GmbH. I have to give it a minimum capital of 25,000, and I'm going to do that to contribute that minimum capital by working for free for that GmbH for half a year. Even if your wage would be adequate, this is not possible. You can even memorize by looking to the word hidden capital contribution. That means whatever you contribute must be capital, not services. It must be something which increases the equity in the balance sheet. That can be giving money, giving assets, which you can recognize in the balance sheet. It can be you renounce on a claim, because then you give your claim to the company against which you have it. The claim ceases to exist, the liability ceases to exist, and the equity of the company goes up. But it always has to be capital contribution, and so you can't contribute services. It's not possible in the open case where you openly contribute, so it's also not possible in the undercover case. Plain and simple, you could say where there is no what let's say where there is no ship, you can't hide a ship. Where there is no car, you can't hide a car. And where there is no capital contribution, you cannot hide a capital contribution. So that's the reason why a service cannot be a hidden capital contribution. So if some shareholder gives a service for free to his own company, that is not a hidden capital contribution. Never forget that. So if you render a service for free or for too low a price to your own company, that's nothing, not a contribution. It's just a very favorable business transaction for the company. One could say the company has found a nice idiot as a business partner where it profits from. So no adjustment in the first moment, at least. This effect, by the way, that it is possible to give a service for free to a subsidiary or to your own company, that makes it necessary that in cross-border cases you create some additional rules to make it possible to correct these things too, because otherwise you would have a problem. Tax planning would become too easy and simple. That's for later. But on the other hand, which forms can then a hidden profit distribution take? And the answer there is no restriction like in the case of the hidden capital contribution. A GmbH can distribute profit in any form because it could, without problems, give money to its shareholders. It is allowed to give assets to its shareholders as a dividend. It is allowed to give them a dividend in form of free services. All these possibilities exist, and so all these things can also turn out to be hidden profit distribution. So everything which you give for too low a price to a shareholder will be a hidden profit distribution. Now, how is such a thing treated in the hands of the person who gets it, so in the hands of the shareholder? Here you should remember a hidden profit distribution is a dividend which has been paid undercover. So a hidden profit distribution is a dividend, so it has to be treated like a dividend. So if you receive a hidden profit distribution, it's nothing else than if you receive a dividend. That means the hidden profit distribution is either taxed with a 25% flat rate if you hold your participation, your shares in private property, and you receive income from capital, or if you collect your dividend income in under another type of income. For example, if you have your shares in your business property, then the dividend will be reclassified into income from business. Then the 25% flat rate for income from capital is automatically impossible. Then in nearly 100% of the potential cases, you end up with the application of the so-called 60-40 rule, or partial income treatment, where 40% of the dividend are treated as tax-free and only 60% of the dividend remain taxable. That is something which you find in paragraph 3, number 40 AStG. That's very convenient, by the way, because paragraph 3 AStG contains a list of all of the most tax-free income which you can have, and that 40% of a dividend is tax-free is exactly in 3 number 40. So the number even reminds you of the percentage. Naturally, if you, the shareholder, are a juridical person yourself, so a parent company usually, then the dividend will be either treated as completely tax-free under the rules of paragraph 8b1 AStG combined with 8b5, or alternatively, if you have a very, very low participation, less than 10%, then paragraph 8b4 AStG states that then the dividend will be fully taxed. So 25% or 60-40 rule never is possible for a juridical person as recipient of a dividend. They only have 8b, either 1 and 5, so complete exemption, or complete taxability. There is something more, ladies and gentlemen, which you should keep in mind, especially when later we come to cross-border cases. There is, when it comes to the treatment of hidden profit distributions, a so-called corresponding treatment principle, or sometimes also called correspondency principle, in German Korrespondenzprinzip. What does that mean? Nothing else than the favorable tax treatment for dividends, so that you get a reduced rate of 25%, or that you get tax exemption for 40% of the dividend, or that you get a full exemption under 8b1 AStG. All these three favorable privileges for treatment of a dividend are granted to you under the aspect, or with respect to the fact, that this underlying, or that the profit underlying the dividend has already been taxed with corporation tax at the level of the company where the dividend comes from. So the idea is you get a reduction of the normal tax burden because that money comes from a corporation which already has paid a tax once. Now, this is merely kind of a condition. So the corresponding treatment principle says, if by coincidence, by error, or by what else, this money has not actually been taxed on the level of the corporation which pays it, then you don't get the reduced rate or the tax exemption as a shareholder. Then that dividend becomes fully taxable in your hands, because then the reduction is no longer justified. Now you can see with an openly paid dividend, that's rather implausible. But when there is a hidden profit distribution, it might happen that during the tax assessment of that corporation which pays out the hidden profit distribution, the hidden profit distribution is not identified as such. And for example, that the excessive amount of a wage is accepted erroneously as a wage and so as an expense. So that money would leave the corporation tax-free, and then naturally for the shareholder, the reduction of the rate of the tax exemption would no longer be justified. That is the correspondent treatment principle. The positive consequence of a dividend is only granted in the hands of the recipient if the negative consequence, a dividend is not a deductible expense, a dividend must have been taxed, if that negative consequence has also actually taken place on the level of the paying corporation. And that can especially happen in cases of such hidden profit distribution, because it might be that, for example, the tax advisor and the tax officer working on the tax accounting of that, let's say, GmbH, who paid an enormous wage of 1 million for somebody, might have thought this is a market-conform payment, and so accepted this. And that only later, when the shareholder is taxed, somebody comes to the idea 1 million is far too high, or is a bit too high, or is at least too high. And so a part of the 1 million is not a wage, but dividend income. Then normally the tax officer working on that case is bound to tax that dividend correctly. That in the tax files of somebody else an error has been made normally has no influence. But here it has. So if you receive a hidden profit distribution and you can't prove that that hidden profit distribution has been correctly declared and taxed on the level of the corporation which pays it out, then you automatically will have to pay the full tax rate for that dividend which you get. So it will be treated as income from capital because it is a dividend, but the consequence will just be you don't get the reductions. So you can just memorize that in a way that you tell yourself, if the negative consequences of a hidden profit distribution have not effectively taken place on the level of the company, the positive consequences of a dividend also are not granted on the level of the shareholder. Then you have regular rate with 45% or so, or individual tax rate, or full taxation with corporation tax rate. When you look in the German Tax Act for the place where you can find the rules of this or about this corresponding treatment principle, then you find them usually placed near the tax privileges for dividends. So near the 25% rule in 30D, you find a phrase which says this rate is not granted if the dividend comes from an untaxed source. When you read 3 number 40, somewhere hidden in that very lengthy list of payments which are privileged under the 60/40 rule, there is one sentence which says this whole thing does not apply if the dividend has not been taxed at the source. And also in 8b(1) there is a rule, the tax exemption for dividends which a corporation receives does not take place if all that comes from a corporation which has not paid tax on it, so where it has been treated as an expense and lowered the taxable income. Examples for how that works, ladies and gentlemen. Imagine a shareholder works as a managing director for his own GmbH and gets a monthly salary of, let's say, 30,000 euro. Now later it turns out a market adequate salary would only have been 20,000. By the way, naturally all these figures are highly blown up. But pardon me, I also have some dreams, and it's simply not fun if we imagine manager gets 2,000 euro and adequate are only 1,000. So let's dream a bit of being rich, and probably taking such high figures also makes this example still plausible in 10 years after brutal inflation. So just live with the figures. Now back to the case. We have 20,000 adequate salary, and so 10,000 are paid too much. A careful and responsible manager would never have agreed to paying 30,000 if 20,000 was enough. So 10,000 excessive payment is simply nothing else than a hidden profit distribution. Now imagine, unfortunately, during the tax assessment of the GmbH, all the people involved honestly had believed that 30,000 is market conform. So everybody had just treated the 30,000 fully as a wage. It was fully deducted as an expense. Now, later, the tax assessment of the GmbH has already become definitive. So the deadline or time limit for changes in the tax notice is definitively over. No changes possible anymore. And well, now the tax assessment of the shareholder shall still be open, can still be changed, because due to some objections related to some totally different things, the shareholder and his tax advisor have a correspondence and a quarrel or dispute with the fiscal office already over several years, and the tax notice has still not reached its final stage. Tax assessment is still going on. That happens. And now, after a while, the tax advisor of the GmbH, of the manager changes, and the new one says 30,000 can't be a wage. Adequate is only 20,000. I can prove it. What you got was not a wage. 10,000 per month were hidden profit distribution. So we tell that to the fiscal office, and now we claim the 25% reduced rate for that. Now, unfortunately, a tax officer always has to treat a tax case absolutely correctly. That errors had been made somewhere else usually are no justification to make an additional error. So the 10,000 must be recognized as a dividend. Now, under normal circumstances, that would force our tax inspector to grant our manager the reduced rate of 25% for that 10,000. So it would be really a positive surprise. First, to treat the 30,000 as a market conform salary, and later, just by coincidence, find out that it's only 20,010 are in profit distribution, because then the money would leave the GmbH completely untaxed, and then you would pay a lower tax, which normally is meant to compensate that corporation tax has already been paid. So the total outcome would not be fitting. In order to prevent that, the corresponding treatment principle has been established, which then orders, legally binding, your tax inspector, if you get a hidden profit distribution, can't prove that it has been treated correctly at the level of the paying company, then the reduced rate, or the 60/40 rule, or 8B1, is refused, and you get treated regularly as regular income. You pay the full individual tax rate, either the progressive income tax rate, or if you are a juridic person, the full corporation tax rate. Example number 2. Imagine lower GmbH is a subsidiary, 80% are held by upper GmbH. Now, lower GmbH does some services for remuneration of only 20,000 for upper GmbH for others. However, they would have charged a price of 100,000. That's undoubted. So no dispute about this. This is the market price. So now it cannot be doubted, if you see these conditions clearly, that we have here a case of a hidden profit distribution from lower GmbH to upper GmbH over an amount of 80,000 euro. Now, if things were to be done correctly, the profit of lower GmbH would have to be increased by these 80,000 euro, because we would have to do as if they had got 100,000 and then a second later had renounced on collecting 800,000, so, or had given 1 second later the 80,000 back to upper GmbH. So that would be a dividend payment to upper GmbH if it had been done openly, and now if it has been mingled together with the other transactions so that you can't distinguish it clearly at the first glance. Nevertheless, it's now still a profit distribution, only a hidden one. Normally, it should be tax-free in the hands of upper GmbH now with 8B1, also triggering a 5% lump sum for non-deductible expenses connected with the dividend reception 8B5. Now imagine, unfortunately, the tax assessment of lower GmbH went wrong. Nobody realized there that 20,000 was too low a price. So nobody saw there the hidden profit distribution. And let's imagine no tax fraud, just a genuine error. They didn't thought about it, were distracted, or didn't know the market prices correctly, and so on. In that case, the 80,000 were never taxed in the hands of lower GmbH. And resulting from that, it's no longer justified to grant to upper GmbH the tax reduction for that dividend which they got if the real circumstances can be noticed later. So the consequence, when a tax inspector later finds out that a hidden profit distribution of 80,000 was received, then the 80,000 would be fully taxable in the hands of upper GmbH, at least as long or under the condition that the tax assessment of lower GmbH is completely all over, done with, and closed. It can no longer be changed. Yeah. Where is now that corresponding treatment principle most important? Well, usually in inland cases, German law says when a time limit, for example, for the assessment of the GmbH is over. Well, then we nevertheless permit to correct it if hidden profit distribution can be found out during the assessment of a shareholder, so that the two tax assessments can be brought in line with each other. So then automatically you can establish the correct treatment on both levels still. So the corresponding treatment principle will have no lasting effect, because once the GmbH has been correctly taxed on the hidden profit distribution amount, the shareholder gets the right to the 25%, to the 60/40 rule, or to 8B1. But now imagine we have a cross-border case. In that case, everything is different. Why? Because imagine you get now a dividend payment from Paris. No, a hidden profit distribution from Paris. Let's say somebody in Paris only asked a price of 20,000 for something which was worth 100,000. So they gave you 80,000 service or part of a good for free. So you received a dividend. And if that is noticed during the tax assessment of the shareholder, normally now the tax officer working on the shareholder's assessment would inform the tax officer who works on the GmbH and says, please correct the GmbH assessment. You are allowed to do that even if the time limit is over under the rules of the AO. You have here an exception. You can still bring the two tax assessments in line. Normally that works. Now, if we have a tax officer working in Paris, and you tell him as a German, well, you can still change your Paris tax notice for the Paris GmbH because German law allows that. Then the French tax officer will shrug shoulders and say, sorry, here we are in France. German law is not applicable to French tax notices. So you can allow me a mass of things, it doesn't count. Here, only French law counts, and French law does no longer allow me to change that tax assessment. So in cross-border cases, it can really become relevant, even in the long run, that the hidden profit distribution happens, is not noticed on the corporation level, and that later the hidden profit distribution is noticed when the shareholder is assessed, and that you then really have a non-corresponding treatment on the both levels, with the consequence that the shareholder has no right to the reduced rate or 60/40 or 8B1. So in cross-border cases, the situation can really happen that you have a non-corresponding treatment, and so the reduced rate or 60/40 rule or 8B1 are lost effectively. So especially in our case, cross-border things, international cases, the corresponding treatment principle turns from mere theory into a very relevant thing for practical cases. Okay. Now, that was how a hidden profit distribution is treated in the hands of the shareholder. Now let's think a bit about a hidden capital contribution. How is that treated in the hands of a shareholder? Again, if you want to understand things properly and clearly, think of a very simple thing. A hidden contribution is nothing else than a contribution. The only thing is, it has been hidden. But hiding things does not change taxation. So it's simply a contribution. And a contribution is an investment. It does not make you poorer. So it is not an expense. So it may not be treated as an expense on the level of the shareholder. If you, for example, buy shares for 400,000, this is just not an expense, it's an investment. And if you first buy the shares for €1 and a month later invest additional 400,000 into that company, these are subsequent costs. So in all cases, contributions are not an expense but neutral for the profit of the shareholder. So the money which our shareholder gives away as a contribution is not a deductible expense. It must not lower the shareholder's income. Well, what does now the corresponding treatment principle say for hidden capital contributions? Well, again, usually the rule is who gets a contribution does not pay tax because a contribution is not a profit. On the other hand, the person who makes a contribution cannot deduct expense. Now again, by errors, this equivalence or this corresponding treatment on the two levels might get disturbed. It might be that by error, during the assessment of the shareholder, the capital contribution is mistaken for an expense. And now it might be, by chance, that the shareholder's assessment is all over and done with, although the GmbH assessment is still going on, can still be changed, happens. And now the GmbH, after a while, could come to the idea, oh, what I received some years ago, that was not a profit, that was a contribution. A non-shareholder would never have agreed to contract conditions like these. They were far too favorable for us. It is a hidden contribution which we got. And then you would have, from the perspective of the first, the maximum catastrophe. Somebody deducts money, let's say 1 million as expense, so that money leaves the shareholder and has lowered the shareholder's taxable income. And now the recipient doesn't qualify it as income, but as a contribution. So you turned 1 million effectively into untaxed income, completely untaxed income within a group or within the relationship shareholder company. That's bad. So in case where that goes wrong, we would try to adjust the situation. It should be necessary to make a balance, to establish a balance here again. And so the idea would be, again, basic idea of the corresponding treatment principle. The positive consequence of the transaction is not granted, and the positive consequence would be a contribution is not a profit for the company which gets it, if the negative consequences of the same transaction have not actually been drawn for the taxation of the other person involved, so of the shareholder. So foreign in capital contribution, that principle means the rule that a contribution is not profit is ignored. It is requalified into profit if the negative consequence, which means contribution is not deductible expense, has also not been drawn. The Tax Act just does this by inserting a rule in A3, sentence 3, which says a hidden capital contribution is reclassified into profit if the person who gave it got away with deducting that as expense, and that can no longer be changed on the level of that person. So imagine again, shareholder X has given a building with a market value of 800,000 to his GmbH for a price of 500,000. Now that building was in the hands of shareholder X business property, so selling it should always have been fully taxable. Now the correct treatment would have been to sell that house for the market price by the shareholder 800,000. And so the cost of acquisition would have been 800,000 for the GmbH. And the fact that the shareholder had renounced on getting 300,000 from that price of 800,000 would have simply been shareholder gives 300,000 to GmbH for free without any reason. This is just hidden contribution. So the shareholder would have to tax a sales price of 800,000 from the house, and that 300,000 were not collected was then in the second logical step just a contribution, so these 300,000 would have to be treated as additional costs for the share. Now imagine that on the level of that shareholder, the shareholder by error got away with declaring a sales price of 500,000 only, and that his tax assessment can no longer be changed. In that case, the corresponding treatment principle would say, we do no longer treat the hidden capital contribution as a non-profit transaction, but we requalify it into a profit. So all other things would be treated correctly. So the cost of acquisition of the house would be corrected to the market conform value of 800,000. Now the equity on the liability side of the balance sheet automatically goes up by these 300,000. Normally now we would say this increase of 300,000 is due to a contribution, is not relevant for profit, but here the corresponding treatment principle has been violated, or it says if the corresponding treatment did not happen, if the negative consequence was ignored, So if the shareholder had not taxed the full 800,000, then the GmbH will have to treat the contribution as taxable profit. By the way, for the reality of life, that means that the tax assessors for the GmbH and the shareholder have to communicate with each other, or that if the GmbH brings forward we have received a hidden capital contribution, they will be asked to prove or to show that everything on the shareholder level was also treated correctly. A variant of this changes everything. In the hands of shareholder X, again, we have a house, but this house is now private property. And the 10 years period since acquisition has already passed. That means selling that house is tax-free for the shareholder. Now, imagine again, the shareholder sells the house for 500,000. True value is 800,000. That has not been realized on the shareholder level. By the way, how should it? Because it was tax-free. Now we have again a contribution of 300,000, but the corresponding treatment principle has not been violated because the shareholder's taxation was not wrong. The 300,000 were unnoticed, but they were also irrelevant. It plays no role that his non-taxable income was 800,000 instead of 500,000. And so in that case, the GmbH would still be able to claim that it had to do with the hidden capital contribution. That is the reason why in 8.3 sentence 3 AStG you find the corresponding treatment principle formulated in a way that the hidden capital contribution is reclassified into taxable profit if the income of the shareholder has been assessed too low, and that means the taxable income. Literally, it has if the income of the shareholder has been reduced by the capital contribution, and in case of our private property which we sold, the price which was too low did not reduce the taxable income of that shareholder in comparison to the correct treatment. So no reason to apply the corresponding treatment principle. Again, where does this play the most important role? Again, you can say in inland cases, nearly every time the other tax assessor, tax inspector is allowed to make a corresponding correction of the original tax notice, so of the shareholder. So in inland cases, it's probably only rarely relevant. But in cross-border cases, you have again the problem that if German law says, well, the tax notice for the shareholder can still be corrected, that a French tax inspector says, well, German law can't allow me to change a French tax notice. This is already beyond the time limit. It stands, it can no longer be touched. I have no possibility to adjust the shareholder's assessment to the new information that there has been a hidden capital contribution, which by error lowered the income because it was not fully taxed. In that case, corresponding treatment principle really applies. So then the German GmbH would be taxed on the capital contribution because one wants to avoid that money leaves the hands of the one party completely untaxed. Shareholder makes a contribution but deducts it as taxable expense. So money goes out, and as an expense, the normal tax burden there goes down, let's say by 1 million or so, or 300,000. And the receiving person then does also not pay tax on it. This would be such a brutal violation of fundamental principles that they say we want to avoid that at all costs. And if the tax assessment of the shareholder can no longer be adjusted, then we draw the consequences on the level of the receiving company. Okay. Okay. Now let's turn to another basic question. We are still, as you see, at the repetition of basics which have to do with contract relationships between a company and shareholders or related persons. Who is now the recipient of a hidden profit distribution? That problem exists where financial advantages are not given to the shareholder himself or herself, but to closely related persons, for example, the shareholder's wife or husband or children, because of their family relationship with the shareholder. The example would, for example, be a GmbH sells a car for 10,000 euro to the shareholder's wife. The true market price is still 20,000. A careful managing director of a GmbH would never have agreed to such contract conditions if he or she had not been forced to consider or to give in to the wishes of the shareholder. And this shows that we here have a case of a hidden profit distribution because that transaction fulfills the definition. Now the question is, who will be taxed on that hidden dividend? You see here that the shareholder's wife is the person who gets the 10,000, but can you tax a shareholder's wife on income from capital if she doesn't own the capital? And so the question is, who will be taxed? And the answer is plain and simple. Look again to the basics. A hidden profit distribution is nothing else than a dividend. And it's exactly treated as if a dividend were openly paid. Now, if everything is done openly and correctly, a dividend is always paid out to the shareholder. So that means if a dividend is hidden, it's also paid out logically to the shareholder. Now, how do we explain that that money in the end arrives in the hands of the wife or child or so? Well, what is economically behind that event? What explains that the money is handed over to the wife or instead of to the shareholder himself? Plain and simple explanation. Economic background is simple. The shareholder wanted to do his wife a favor, so wanted to give her 10,000 to facilitate the acquisition of a new car. If that had been done openly, then the shareholder would have collected a dividend payment of 10,000 euro and then in a second step passed on that money as a gift to his wife and would have said, here is another 10,000. Now you can afford to buy the nice car which you want to buy. That would be the open and honest way to do it. Now, in our example, they have hidden and abbreviated the procedure. Well, so the two payments were simply netted off. Well, wife arrives, has only to pay 10,000, but in principle, logically, 10,000 were given to the shareholder. Shareholder gave it as a gift to wife, and wife then paid 20,000 for the car. The only thing was the payments were abbreviated and netted off against each other, but the underlying economic situation is nothing else than what I explained just now. And so indeed, if we reconstruct what economically lies behind that hidden maneuver, two transactions. Again, the market-conformed transaction, company should have sold the car for 20,000 to the wife. And we do as if that happened this way. And then 10,000 have been passed on to shareholder, and shareholder has given that 10,000 to his wife. So the second shareholder would have income, and passing over that income to the wife or child would be a gift, so no taxable income, but probably relevant for the inheritance and gift tax. Indeed, it's exactly treated this way when it comes to application of inheritance and gift tax. Such a hidden profit distribution, which ends up in the hand not of the shareholder but of a related person, will be relevant for the inheritance tax. Okay. The same logic, by the way, can also be applied for a hidden capital contribution. An official capital contribution is always made by the shareholder himself or herself. So a hidden capital contribution is exactly the same, only hidden. So a contribution can only come from the shareholder, also the hidden one. Now, how can we explain that somebody else gave that money to a GmbH and not the shareholder? Well, in such a situation, the underlying economic background must be explained as follows. The close friend or relative wanted to do the shareholder a favor and give him as a gift the money which the shareholder needs to keep his or her company alive. So that is what we have to reconstruct behind a hidden capital contribution, where the money comes from not the shareholder himself or herself, but from a related person. So in an example, Mr. Junior, imagine, is the proud owner of a small GmbH. Unfortunately, that GmbH is in a very bad condition. It needs some success and it needs urgent help. Mr. Junior, who happens to be the father of Mr. Junior, decides to help his son generously. He buys the office building which belongs to the GmbH for a price of 800,000, although this building in reality only has a market value of 300,000. So this poses a question. Is this a hidden capital contribution? And the answer is yes. Such a contract would never have been agreed upon by a normal business partner in this way if Mr. Junior had not been the shareholder. What economically underlies the transaction is nothing else than Mr. Senior wants to help his son to make him a donation, a gift of 500,000 under the condition that the son invests that money into the GmbH, and they abbreviate the way of payment just by immediately pushing undercover these additional 500,000 into the GmbH by paying too high a price for that house. So what economically happens is we have a donation from senior to junior that might even trigger inheritance tax. And then junior made a contribution from his private sphere to the GmbH. So junior has the additional cost of acquisition for his shares in the GmbH, which naturally makes sense. What do all these principles mean for transaction between sister companies? Hidden profit distributions always go to the shareholder. Hidden capital contributions always come from the shareholder. Now, what happens if you do something for another company in the group for a very favorable, not market conform price? Imagine, please, the situation which we have here. GmbH A sells a car with a market value of 40,000 for a price of only 20,000 to GmbH B. And GmbH B now, ladies and gentlemen, is nothing else than a sister company. Shareholder Jean Roos from Generous is the 100% shareholder of both. So if GmbH A is willing to give away a car with a value of 40,000 for a price of only 20,000, this is a favor which GmbA does to a related person of the shareholder. So it's a hidden profit distribution to the shareholder, And the second logical step is the shareholder passes on that advantage as a contribution to his second corporation. So in that case, our shareholder, Gene Goose, would get a dividend of 20,000 from GmbH A, would have to pay taxes on these 20,000, and then passing on 20,000 as a capital contribution to GmbH would then increase his cost of acquisition, and GmbH B would show the 20,000 as a capital contribution, so as additional paid in capital, and would regard the car as bought for the economically correct cost of acquisition of 40,000 instead of 20,000. So transactions between sister companies are always construed as involving the shareholder, at least that's the German perspective. So you have a hidden profit distribution from the one company to the shareholder, and a logical second later, the shareholder passes on the received advantage to the second company, probably in form of a contribution. Naturally, if a service is traded, we end up with problems to treat that passing on of a service into the second company as a contribution. In that case, the situation varies a bit. Then we have to think what we have to do. Then here we would have again GmbH A, GmbH B. Let's say now 80% is owned by shareholder X and 90% is what shareholder holds in GmbH B. That is just to show you that you do not need a 100% participation. That somebody is a shareholder is already enough. Now GmbH A gives a service to GmbH B, and the market value of the service shall be 50,000, but they get it for 25. What that means is nothing else that GmbH A accepts the order for 25,000 instead of 50,000 in order to do their shareholder X a favor. So that means we have here a case of a hidden profit distribution. That means the money goes to shareholder X in our imagination. He gets half of that service for free from the GmbH. So GmbH A is treated as if they had earned the full market price and passed on 25,000 to the shareholder. Shareholder receives a dividend income of 25,000. Now in the next step, the shareholder passes on the received advantage, that is half of a service for free, to its GmbH B. As this is now a service, it can't be treated as a capital contribution. So for GmbH B, nothing happens. It's just a favorable transaction. Their profit remains high, only 25,000 expense instead of 50,000, just a favorable transaction. On the other hand, when it comes to the tax assessment of shareholder X, we have to acknowledge that the 25,000 in form of a financial advantage, which X collected from A, are no longer there, but have vanished. He passed them on. That's the same as if he gave away. No, he lost that thing. At the end of the year, it's no longer there. So you had to write off the economic value of that service. So 25,000 again vanished. So you have minus 25,000. This is expense for X, which he can claim deductible expense. You remember when somebody gave a service, for example, then the cost of the service, if it costs costs, then that's still a business expense for the shareholder. And the GmbH does get nothing because it's a service, no contribution. The treatment on both levels would remain unchanged. So that would shift money between the two companies here. In the end, the shareholder could claim expense and GmbH B would have too much money. What does the corresponding treatment principle say for such constellations? Now it gets really nasty. Again, A and B. A sells now a crane to B for a price of 100,000 instead of 200,000. We have now hidden profit distribution. Now imagine that hidden profit distribution has been overlooked, and so A has only paid a price, only paid taxes on 100,000. So the 100,000 additional value have left the sphere of GmbH A without ever having been taxed. That cannot be tolerated. We have to recover the tax somewhere. So the consequence of the corresponding treatment principle would be, well, if a hidden profit distribution has been made on the level of a corporation, the dividend will be fully taxed in the hands of the recipient. So we would say that we would probably tax the dividends in the hands of the shareholder. Now it could also be that even when the shareholder was taxed, that was not seen, so that in the end we have only the possibility to say that, okay, if the money has been passed on now from shareholder X to GmbH B and it has not yet been taxed on the both other levels, then B receives a contribution which violates the corresponding treatment principles, so we would have to requalify that into a profit so that the money does not end as totally untaxed income within the group. If you don't understand that immediately, don't worry, that's just a sign for your common sense and that you are not already turned mentally ill from dealing too much with tax law. So that takes time to get used to all that stuff. Naturally, these rules also apply to cross-border relations, and so we have to think about where are now gaps in the system. For example, that a hidden capital contribution cross-border cannot be corrected or cannot be applied in cases where a service is granted. We have to find out where additional rules are required to prevent unwanted effects, tax-saving models where people shift money arbitrarily from one country to the other. So if a subsidiary hands over something to its shareholder, we can always adjust things as a hidden profit distribution. So there is probably no case where we cannot adjust things to market conform conditions. So probably no gap when we apply the standard rules. No need for additional rules there. When, on the other hand, a shareholder, let's say a sole trader, parent company, or something else, gives an advantage to a subsidiary, then it's only a hidden capital contribution which allows an adjustment. If money or assets have been given, if a service has been rendered for free or for less than the market value, then you have no possibility to correct the transaction and the result under the normal rules. That would allow a deliberate manipulation of the profit by the shareholder and the subsidiary. So in a cross-border relation, you could easily shift money from one state to the other state. And that has drastically different consequences. In a national context, you would have it plain and simple, and probably it would not be really a catastrophe. German low GmbH takes an order for a customer, and the customer will have to pay 10 million. No, low GmbH does not have the necessary people for working on that order. and so they borrow staff from the parent company, the upper GmbH. Now the wages for that staff are naturally paid by upper GmbH, 9.5 million. But upper GmbH lends their staff to low GmbH for free, and that brings along which consequence as well. The transaction is not conform to market conditions. The shareholder gives something for free to low GmbH, but what is given is a service, so it's not a hidden capital contribution. So we don't correct the tax accounting of upper and lower GmbH. So low makes a profit of 10 million and upper can claim an expense of, now that must be 9.5 million. So the profit of low GmbH goes up considerably and the profit of upper GmbH goes considerably down. But on the other hand, the total tax effect would probably not have been completely different if low GmbH and upper GmbH are both in the same state. There is no big tax saving effect available in the average conditions. Now, in an international context, the whole thing has consequences which are different. Imagine now we have an Irish low limited which takes an order for a customer and the customer has to pay 10 million. The expense will again be 9.5 million. And again, we have to borrow the necessary people to work for the order from upper GmbH. Now, upper GmbH continues to pay the wages, 9.5 million. Again, upper GmbH lends the staff to low GmbH for free. So now we have no hidden capital contribution. We can make no adjustment under that rule. But the final effect is now that 10 million and the expense necessary to create these 10 million have been separated from each other. The 10 million end up in the Irish jurisdiction, the 9.5 expenses end up in the German jurisdiction. What are the consequences? The Irish tax is 12.5%, at least it has been for a time so. I'm not guaranteeing for the details, but this example would now present great possibilities to influence the tax arbitrarily. Giving the revenue to low limited ends up with a tax burden of 1,250,000 euro. And that you can deduct the expenses in Germany, where the tax burden usually is 30% of an amount, lowers the German taxable income by 30%, by 9.5 million, and that lowers the German tax payments probably by 2,850,000. So before, we have a net effect from that splitting up expense and revenue to different states in a completely legal way of minus 1.6 million. So here the total tax outcome would be negative, although you make a small profit. It would even be hilarious. You make a profit of 500,000 and additionally you lower your total tax burden in the group by 1.6 million. So that artificial split up of revenue and expense to different jurisdictions increases the rentability of the order from 500,000 to 2.1 million, just because we have no possibility under the standard rules to correct the non-market conform behavior between parent and subsidiary company. That can naturally not be tolerated, ladies and gentlemen. It would be highly detrimental. We all would do that, establish a company in a low tax state, and then do the work for free for it and deduct here the expense from our otherwise taxable income. Consequence, we need an additional rule to close that loophole, and this is 11 AStG, which contains an additional rule for correction of cross-border transactions. Important is that additional rule only is applied by the German tax law to cross-border transactions. So within the state, we still respect or accept the possibility that you can shift via a service for free potential profits from a shareholder to a company without that this is corrected. Note further that 1 AStG is a subsidiary rule. It is only applied to that amount of profit which could not be adjusted to market conform amounts under the standard rules. So only if there is a leftover of non-market conform conditions, 1 AStG can be applied. All these standard rules are applied first, and only the remaining difference to the market conform profit will be additionally corrected under 1 AStG. So 1 AStG is only applied if and insofar the usual rules have not turned out not to be sufficient. Especially that means in the case where a service is given for free or for a reduced price to a subsidiary company. So the rules about hidden profit distribution and hidden capital contribution always prevail. They are applied first, and only if something is left over, 1 AStG is applied. What does the rule say? Here is a personal translation by me. You can also find in the internet on the pages of the Bundesfinanzministerium an official translation, which you find if you Google External Relations Tax Act. Then you can compare. It just says, if a cross-border business relationship of a taxpayer with a closely related person results in an income of the taxpayer which is lower than it should have been due to the fact that conditions have been agreed upon which would not have been agreed upon by unrelated third parties under the equal or similar circumstances, then the income of that taxpayer shall be assessed as high as it would have been under conditions which would have been agreed upon between unrelated third parties. And that does not exclude the application of other rules, so that means the other rules are first applied and then 1 AStG is tested. Plain and simple, if the standard rules are not sufficient to correct your profit to a market conform extent, and it's still too low, then 1 AStG allows you to add up the rest until you end up with a totally market conform profit. It's then said that as taxpayer counts a company, a partnership, or an individual, that plays no role, so formal things don't count. So contract relationship between entities of each legal form will be inspected if they are conform with market conditions. If not, then an adjustment under 1 AStG is made if the normal rules are not sufficient. Yeah, that's plain simple stuff here. Please note that AStG paragraph 1.1 is only applied if the manipulation leads to a lower income. So if you have non-market conform conditions and these lead to a too high income in the inland, for example, you are the subsidiary in the inland which got a service for free from your parent abroad, then bad luck. 1 AStG just allows to increase the profit in favor of the tax administration, but not to lower it down to a market conform level if you got too much. In such a case, you can only look for other legal legal basis, which allow you to correct the profit down to a market-conform extent. That might be found, for example, in Article 9.2 of the OECD Model Convention, but not every German double taxation treaty contains a parallel to Article 9.2, and so that might be problematic. Yeah, 1.1 AStG can apply to every taxpayer, even if the taxpayer does not reside in the inland, as far as that taxpayer's income is relevant for German taxation. So within the limited or unlimited tax liability, you can correct a profit to market conform extent in cases of 1.1 AStG. So, for example, if you have a foreign taxpayer with a permanent establishment in the inland, and the permanent establishment didn't compute the tax profit according to market-conform conditions, then adjustment is possible. Or if you have an inland taxpayer with a permanent establishment abroad, and the permanent establishment abroad has calculated too low a profit, and that permanent establishment abroad is nevertheless still covered by German tax claims because it's not exempted under a double taxation treaty, might happen, then also an adjustment is possible. Yeah, keep in mind 1.1 AStG only applies if all the other rules have been already applied and there is still a leftover of non-market conform things. Always applied at last. So hidden profit distributions and hidden capital contributions, the rules about them have to be applied and tested first. But now, ladies and gentlemen, I have already talked for a long while, and probably both your ears have dropped off already. So we should think about something specific. That means we should think about a break, because there is still much to come and the video will otherwise become much too long for today. So let's have a break here. The second half of that topic is going to come soon. Enjoy the time till then. Don't forget to memorize all these things, work on them, practice them, and naturally at the end, always the same wish from me to you. Please, if you like the video, press the like button to increase the reputation of the channel, and share the video with people whom you like if you liked it. And if you especially did not like it, then please share the video with people whom you don't like. That's finished for today. Go away, enjoy the evening or the rest of the day whenever you watch this, and see you again soon. Thanks for watching. Good